So now we want to model the lease payments on existing lease liability under the finance leases. So in order to do that, we will take into account the principal repayment of those leases in addition to the interest. So what we are saying here is that this is the total debt service for the finance leases. However, we will have to later on deduct the interest expense embedded in the total debt service to arrive at the principal repayments, which we will use later on in our cash flow statement for the total principal repayment of finance lease obligations and operating leases. So what we're going to be doing here is that we will develop a formula embedding the principal and interest, and the later one we will deduct the interest from the total debt service under this finance lease liability. So that's what we're going to be doing here. So we want to calculate the repayment, which is the total lease payment, including the interest. So in order to do that, we will set this to be equal to an if statement saying if the opening balance, we have to reference a cell since we have to pay off $18 billion in the next 10 years. So we say that if that opening balance divided by, we go to the control panel, at weighted average remaining lease term of 6.2 years. So that opening balance has to be paid for the upcoming 6.2 years. So we say that if that opening balance divided by the weighted average remaining lease term for the existing leases, if that is plus the portion of interest, if that included with the interest is less than this opening balance, it means that there is still a balance remaining to be paid. Then what we want is to take this opening balance, which we have to reference with F4 two times. We have to reference with F4 just once. We take the opening balance divided by the weighted average remaining lease term for existing leases. That is at 6.2 years. Minus the portion to interest that needs to be paid. So essentially we are just what we are doing is we are just adding the beginning balance plus the interest, but we are just making all of that negative since we just want negative numbers to appear as negative for the lease payments. So we have that set up. Otherwise, we will just pay whatever is left. We take the negative of the beginning balance and the interest. That is, we are basically saying that whatever is left, we're taking the negative of, meaning we are adding both the beginning balance and the interest, the portion of interest, but we are making everything negative since we want the repayment to be negative, the lease payments to be negative, so we just have that in place. And we can close the bracket once and we press enter. So if we auto sum this, and then it's going to be a calculation where the opening balance is equal to the prior period's closing, then we could reference the the existing asset with F4, the portion of interest with F4 in our control panel. We can fill this all the way right with Control R. We can take all of this and fill it to the end of the decade. As you can see, this is being paid for 6.2 years. So $18 billion is going to be paid for 6.2 years. As you can see, by the end of 2027, everything gets paid off. So that's exactly how we model repayments for lease payments on existing lease liabilities. It's very, very important for us to understand how these repayments are being modeled. But however, what we are saying here is that this includes interest. So when we will be determining the principal repayment, later on, we will have to deduct that portion of interest, so we can account only for the principal repayment of the finance lease liability. So for the new leases, we know that the beginning balance is going to be equal to 0 for that period, and then the net additions, we already have that set up for us in our right of use of assets. So we know that the additions that we made in the period was based on the revenue, and we have that already in the finance lease section of the right of use of assets. So we just